Hello, everybody, and I'm hoping you guys all had a great week and kept warm. Hey, I got about a few items for you today. We're not going to talk about rates, but we're going to talk about some important things that have come up recently. So let's talk about those first. So first of all, there is a huge change, and I mean a monumental shift in our industry that is going to happen on May 1st. Now, lenders are going to start pricing this in probably about the second week of March. But basically what's happening is Fannie Mae and Freddie Mac are adjusting what's called their loan level pricing adjustments. This is basically a tax on the mortgage, and these adjustments are really going to dramatically affect the industry. It's going to make mortgages significantly more expensive for a majority of the people. A minority is going to have a little bit more benefit on it. But basically, let's talk about what a loan level pricing adjustment is. It's a risk, and there's a cost associated with that risk. So as you have a higher FICO score or a lower FICO score, there's more of a risk to it, so there's more of a cost to it. The cost can be either paid by the borrower or more than likely it's rolled into the interest rate. So as an example I gave here on a $300,000 loan, if there was a 0.625 loan level pricing adjustment, that would actually cost the borrower or adjust the interest rate by $1,875. So it's a pretty significant. So what they did is, first and foremost, they expanded the FICO scores. So now, before it was like 680 to 700, 700 to 740 or whatnot. Now it's a lot more narrower of a FICO range, and they've added a 680 or higher, 780 or higher FICO score range. Another big thing is debt to income ratio. If you have, no matter what your FICO score is, if you have a debt to income ratio, which means you take your income divided by your debts, over 40%, they're going to make the loan more expensive for you. So now that you've had this 40% debt to income ratio, now your interest rate's going up, so your debt to income ratio is even higher. Kind of a bad thing for a lot of people. There is a huge cash out loan level pricing adjustment now. So if somebody wants to do a cash out, it is going to cost them a boatload of money in interest rate or fees to get this done. And when I say fees, and this is across the board, this is all lenders that have Fannie Mae or Freddie Mac loans. So this is going to affect everybody basically in the nation. And the other thing they adjusted is they adjusted more adjustments for somebody's buying a second home or if they're buying an investment properties. Again, it's going to be significantly more expensive in the way of interest rate and or fees to get a second home or an investment property. So I'm just going to look at this quick chart right here. This is kind of what we call a hot chart, and this kind of shows where all the adjustments came in at and who is, for better lack of words, being penalized the most for the adjustments. Green means there's hardly any adjustments, and then obviously as you go to red, you can see if somebody's putting 20 to 15% down and they have less than a 639 FICO score, it's not going to be a pretty interest rate. The other thing about it is they adjusted all the rates for anybody, and that's anybody that isn't putting more is putting more than 20% down. And the reason for that is if you don't put more than if you put say 15% down, you're going to have mortgage insurance on it. That means the mortgage insurance companies are going to be at more risk because you put less down and you have that mortgage insurance. So because of this, Fannie Mae and Freddie Mac feel that they don't have as much risk, so the interest rates actually improve a little bit. So you can kind of see basically off this one. So basically, if you look like at a 75% loan to value at a 720 FICO score, that loan level pricing adjustment is 1.25% or $1,250 for every $100,000 you borrow. So kind of the moral of this story as realtors is if you have people pre-qualified, they're going to need to be pre-qualified. The significance of these changes will probably cause people to not be qualified, or they're going to be qualified for less. So definitely keep that in mind as you go through it. If a lender that you're utilizing has not mentioned this or is not pre-qualifying everybody, you probably need to give them a phone call. Hey, let's talk about triggering leads right now because this is another huge item that has come up. I'm going to put a flyer down below in the email that you can download. You can actually hand the client. So basically, anytime a lender pulls a credit report, no matter what lender it is, if Equifax, Experian, and TransUnion sell that. It's called a triggering lead. So a mortgage company pulls a credit report. The bureaus say, hey, this is a mortgage company is pulling a credit report. This is a triggering lead. There's no way around these. A lot of lenders have said we can do this and that and the other. Now, there's not. There's not really a way around this. So what happens then is that triggering lead is then sold to big banks, big credit unions, lenders. Even I could buy triggering leads. We don't. And they get bombarded with calls. I pulled in December a borrower's credit report. Within 5 days, she had 32 phone calls on triggering leads. And she was on the do not call list. So all those people that called her violated the do not call list. We do really encourage people to call to register the do not call list. It might help. We're hoping it helps, but it is what it is. So basically, the disadvantage to borrowers is they're going to get tons of unwanted phone calls. They're going to get tons of harassment from lenders and big banks and big credit unions. There's some privacy concerns out because now all these people have a copy of this credit report, which you, the borrower, has only authorized one person to see. So you're going to get a lot of frustrating clients because they think that the realtors and or the loan officer, in my case, are selling this information. That's totally false, totally wrong. So as a realtor, education. As you talk to borrowers and they either are getting it pre-approved or may get pre-approved, talk to them about triggering leads. Super important. Hey, we got a brand new program with a lender that's come out that does a great job in lending, and it's a new construction loan. So basically what's happening here is if you have a builder that doesn't have a line of credit, or you have a builder that doesn't want to use his line of credit, we have an option for you right now. So this is for borrowers and builders, it's a one-time close loan, which means, let's say you're just in the construction phase and it is one-time close, which means we're going to close this loan up front. The builder is going to take draws over the next 11 months or so. And at the end, it finalizes and becomes a permanent loan. Now, a couple cool things about this lender that a lot of other lenders isn't doing. First of all, during the construction phase, the borrower is only paying interest-only payments. So that's pretty cool. The second of all is if rates drop, the lender will automatically, you don't have to ask them. A lot of lenders you have to ask. If you don't ask, they won't do it. But a lot of this lender will automatically drop the rate down if the rates have fallen. So that's pretty spectacular. Only 5% down. So somebody can get a new construction house, get the house they design, the house they want, and they only need to bring in 5% of their own money. Interest-only payments on that one. Conventional, so 15 or 30 years. There are some ARMs, but I think you all know my opinion about ARMs. I'm not a big fan of them. Primary home, secondary home, and the nice thing is investment property. The other thing is the borrower can already own the land, so we can incorporate that land in there. So for you realtors, the benefit on this one is you get to sell more homes. And last, I'm going to bring this up one more time. I talked about it a few weeks ago. The VA does allow a seller to pay off a veteran's debts, car loans, student loans, credit card loans, installment loans. This is a super great program. VA is a great program in general, but this allows somebody to maybe qualify for a higher house, have the seller concessions pay for it. I know some of the big builders right now are giving out like $30,000. Can you imagine how much $30,000 could pay off in a borrower's debts? And the benefit to you as a realtor, again, you get to sell more homes. So thank you very much. I appreciate your business as always, and make it a great day.